Peace. Welcome back to the Absolute Boss Collective. In this video, we're going to talk about the major indices. I'm going to break them down for you. This video comes from a question from one of my personal friends, a very special young lady. We just going to call her Mo Money, okay? And we're going to break it down because she reached out to me. She asked me this question, and I was like, damn, that's an excellent question. So we're going to break down the major indices. We're talking SPX, which is the Standard and Poor's S&P index. We're going to talk about the NQ, the Nasdaq. We're going to talk about the Russell, and we're going to talk about the Dow Jones Industrial Average. And you're going to need to stay tuned to the entire video because is the Dow Jones an index or not? This is pertinent information. This is going to prepare you so that you can navigate these markets, whether you're investing or trading, okay? So shout out to my homegirl, Mo Money. This video is for you. If I don't answer all your questions, just hit me up in the comments and I will cover what I didn't cover in this video. But you know, absolute means complete. So I'm going to do my best to break it all down for you. Stay tuned. Now we're going to talk about the Nasdaq Composite, IXIC, and the Nasdaq 100, NDX. Okay, so the Nasdaq is an acronym which means National Association of Securities Dealers and Automated Quotations. It is the second largest stock index on Earth. It operates two major indexes, the Nasdaq Composite, IXIC, and the Nasdaq 100, NDX. Nasdaq Composite tracks the performance of more than 3,000 stocks, while the Nasdaq 100 captures the performance of the exchange's largest non-financial companies. The Nasdaq has a high concentration of technology firms. The Nasdaq is often considered a stand-in for the performance of the overall technology industry. Tech companies make up about 50% of the index. Consumer service companies hold about 20%, and healthcare companies constitute 10%. The remaining companies are in utilities, oil, and telecommunications. The Nasdaq is a market cap weighted index. Each company included in the index is weighted based on its total market capitalization. If you don't understand that, leave it in the comments. I could break that down in another video. As a market cap weighted index, each company included in the index is weighted based on its total market capitalization, or the market value of its outstanding shares. If you need me to go into that deeper, leave it in the comments and maybe I'll make a video about it. Okay. Now, with this market capitalization, big companies will have a larger capitalization. Therefore, they will have a more significant impact on the index performance. Okay, so you'll see things like, Apple or Google or Tesla, if they have huge moves up or down, you'll see that reflected in the Nasdaq because they have such a large market capitalization and a weighting in the index. Okay, that don't make no sense? Leave it in the comments and I'll break it down. Okay, even though Nasdaq contains thousands of stocks, 43% of its portfolio is made up of the top 10 stocks. Those stocks are Apple, Microsoft, Amazon, Facebook, Google, Tesla, Google. There's two kinds or two classes of shares on Google. You'll have Class A, Class B shares. NVIDIA, PayPal, and Intel. Okay, let's go. Okay, so the Nasdaq has beaten the SPX or the S&P 11 out of the past 13 years. Now, it's heavily weighted in tech, as we stated earlier. So since tech is such a phenomenal industry, it's performed phenomenally, that's going to account for a lot of the outsized returns that the Nasdaq has. It also causes huge drops. So if you look at 2008, the 2008 recession and a dot-com bubble burst, it had a huge negative impact on the Nasdaq. Okay, so now let's talk about the Nasdaq 100. Okay, because we were just talking about the Nasdaq Composite, the IXIC. So now we're talking about the Nasdaq 100, ticker symbol NDX. In the intro, I did say NQ, and NQ is really like if you wanted to trade options on this index, I believe that's what you would use, that NQ symbol. I don't know why I said that in the intro. I was tripping. The Nasdaq 100 tracks the 100 largest Nasdaq companies by market cap. It uses a modified market cap weighting. 50% of it is weighted towards technology industry companies. The weighting of companies is rebalanced once a quarter in March, June, September, and December. So we got one coming up soon. Companies that fail to meet the Nasdaq's rules for inclusion are replaced with new firms once a year in the third week of December. Now, if you want to invest or trade and benefit from the moves of the Nasdaq, you can look at my favorite ETF vehicle of choice, which would be the QQQ. The QQQ has 180 billion assets under management. Now, let's say the triple Qs goes up $1, okay? If you wanted to be highly speculative, and if you wanted to take more risk, you can trade the TQQQ. It's a leveraged ETF with 12.5 billion in assets under management. However, it is way more risky. So, conversely, if the triple Qs goes down $1, the TQQQ is going to go down $3. So you have to be very careful in trading those leveraged ETFs. You can also use 1Q, which is ticker symbol ONEQ. I've never traded that one, but I came across it in my research, and something I'm going to be looking at going forward. Okay, and that's pretty much it on the Nasdaq. Okay, yeah, that's about it. Let's talk about the Dow Jones Industrial Average. This joint is 130 some odd years old, so we're gonna talk about that right now. Its ticker symbol is DJIA. It is the average of 30 selected stocks, typically referred to as blue chip stocks. It was created by Charles Dow in 1896. The Dow is a price-weighted index. It covers all industries except transportation and utilities. Dow Jones is one of the oldest benchmarks, first calculated on May 26, 1896, with the second oldest being the Dow Jones Transportation Average. The name comes from its creators, the Wall Street Journal editor Charles Dow and statistician Edward Jones. 30 blue chip industrial and financial companies in the U.S. is what makes up the Dow. It's used by the media as a barometer of the broader stock market and the economy as a whole. The Dow scope is more limited than the broader SPX because it's only based on 30 stocks. Since it is price weighted, the index is calculated using a divisor to normalize the index components. If you don't understand what that means, leave it in the comments below. The Dow Jones Industrial Average is easy to calculate. The 30 companies are 3M, American Express, Amgen, Apple, Boeing, Caterpillar, Chevron, Cisco Systems, the Coca-Cola Company, Dow Inc., Goldman Sachs, the Home Depot, Honeywell, IBM, Intel, Johnson & Johnson, JP Morgan Chase, McDonald's, Merck & Company, Microsoft, Nike, Procter & Gamble, Salesforce, the Travelers Company, United Health Group, Verizon, Visa, Walmart, Walgreens Boots Alliance, and the Walt Disney Company. Charles Dow had the vision to create a benchmark that would project general market conditions and help investors bewildered by fractional dollar changes. It was revolutionary at the time. This was a revolutionary idea at the time. And it was very simple to implement. To calculate the first average, Charles Dow just added up the stock prices and divided by 11. And that's how many companies were in it at that time when it was created in the 1890s. In this day and time, the Dow Jones is a benchmark that tracks American stocks that are considered to be leaders of the economy and are on the Nasdaq and the New York Stock Exchange. The Dow Jones covers 30 large cap companies which are picked by the editors of the Wall Street Journal. The companies in the Dow have been changed over the years so that it stays current in its measure of the U.S. economy. So if you look back in the past and see some of the other companies that was in there, they're not in there now. As a matter of fact, none of the initial companies in the average remain. General Electric holds the longest tenure of 110 years. Eventually, they got the boot. The Dow now uses its own divisor because when it was created, stock splits and dividends weren't commonplace. Companies are ranked based on their share prices. The long history of the Dow serves as a reminder of and comparison for today's market compared to early markets. Okay, so all that's saying is we can use the Dow around certain events that happened in the past and kind of use that to kind of think about or predict or speculate on what can happen today. Okay, we're going to move over and talk about the Russell 2000. Okay, now when you typically see news reports and they talk about, how the market fared on any particular day, they'll talk about the S&P, SPX, they'll talk about the Nasdaq, and then they'll talk about the Dow. Okay, the Russell don't get no light. They don't show the Russell no love. They don't put no respect on the Russell. However, for those that are in the know, you can look on any one of these financial websites and you can find the Russell. Okay. Now I'm going to tell you why they really don't speak about them on the news. And that's the Russell 2000. It tracks small cap stocks. Okay. It's an index that measures the performance of 2,000 smaller companies that are in the Russell 3000 index. Okay. It's managed by FTSE Russell, which is a London Stock Exchange company. And it is regarded as a bellwether of the U.S. economy because of its focus on smaller companies, okay, that focus on the U.S. market. So we all know that small business is what makes this country, okay? It was started by Frank Russell, or the Frank Russell Company in 1984, okay? Is frequently used as a benchmark for measuring the performance of small cap mutual funds. Okay, it is made up of the bottom 2/3 in company size of the Russell 3000 index. Mutual fund investors favor the Russell 2000 index because it reflects the investment opportunity presented by the entire market rather than opportunities offered by narrower indices. Many mutual funds and ETFs are tied to or based on the Russell 2000. As of July, the average value for a company on the Russell 2000 was $3.27 billion. The median market cap was $1.19 billion. The Russell is weighted by shares outstanding. This means that a member stock's last sale price, as well as the number of shares that can actually be traded, influence the index. Each June, the Russell 2000 is rebalanced and new companies are included or deleted from the index. In May and June yearly, the Russell 2000 announces changes to the small cap index. Okay, and if you wanted to trade or benefit from the moves of the Russell, you want to look at the ETF IWM. I am pretty sure there are others out there that track this index. This is the one that I use. It's the most liquid. So the ticker symbol for that is IWM. I inadvertently didn't mention the Dow, which is, if you want to capitalize on the moves of the Dow, you want to use the ETF DIA. Okay? So now, we've covered the Nasdaq QQQ, the Russell IWM, the Dow Jones DIA. Now we're going to move over to my baby, the love of my life, okay, my sweetheart, the S&P, okay? Standard & Poor's 500. It's a market capitalization weighted index of 500 leading publicly traded companies in the United States. Now, to be a large cap company, you got to pull in 13 billion, okay? At least somewhere around 10 billion and up. That's how much cake you got to be making to be considered a large cap company, okay? The S&P is regarded as one of the best gauges of the large cap U.S. equities, okay? It's a float-weighted index, which means the market capitalizations of the companies in the index are adjusted by the number of shares available for public trading. Why I started trading the SPY, and if you look at my account on any given week or even any given day, most of my trades are on the SPX. I trade the SPY, which is the ETF associated with that. And one of the reasons I started trading that was because I learned that it was the most liquid. It was the most liquid. So that is just a testament of what it says, that, it is the highly regarded measure of U.S. equities. Okay. Many funds are designed to track the performance of the SPX. The SPX gives a higher percentage allocation to companies with the largest market capitalizations. So like with the Nasdaq, when you see, adverse moves in some of the heavily weighted stocks, you'll see that reflected in the index as a whole. Okay, the SPX is the institutional investors' preferred index due to its depth and breadth. The SPX represents U.S. equity markets better than the Dow because it comprises stocks across all sectors. The larger the market weight of a company, the more impact each 1% change in a stock's price will have on the index. The SPX was created back in 1957. It was the first U.S. market cap weighted stock index. Okay. The top 10 holdings are Microsoft, Apple, Amazon, Tesla, Google, both shares. You got GOOGL and GOOG. Facebook, Nvidia, Berkshire Hathaway, BRK.B. That's the B class shares. They also have two share types or two classes of shares. And JP Morgan Chase. Okay, for all of the party people that stood to the end, and especially for my homegirl, Mo Money, I put together what I call a patent play. Okay, Mo Money gonna know why I call it the patent play. And what I did was I tracked these 4 indices from December 11th, 2013, all the way up to October 29th of this year, 2021. I wanted to see how they performed. The reason why I checked December 11th, 2013 is because that was a confirmed down day. Okay, so that was kind of like a bottom. Okay, so if you were to purchase these ETFs associated with the indices that we discussed, the QQQ, the SPY, Diamonds, DIA for Dow Jones, and the Russell, IWM. If you purchased these indices December 11th, 2013, let's see how they would have performed up to this past Friday. Okay, so the Nasdaq QQQ was trading at $85.18. It closed Friday at $386.60, which equals a return of 353.86%. Okay, so you would have made 350% on your money. Okay, with that index alone. Technology, baby. Let's look at the S&P, my baby. Kind of didn't make it here. At that start date, it was $178.72. And let me tell you something, I would love to buy it at that price right now. Okay, and Friday it closed at $459.69 for a return of 157.21%. Not too shabby. 150% on your money. Okay, that's not bad. The Dow Jones, 158.31 to 358.78 for a return of 126.63%. Then we have the Russell, IWM, 109.60 to 228.38 for a return of 108.38%. And that's the patent play. Okay, so you would have made some serious money, okay, holding that for just about 8 years. Okay, so that's something for y'all to think about. If you're new to the channel, consider subscribing. Leave me a comment below if you have any questions or concerns about anything that was discussed in this video or any other video. Okay, make sure you hit the notification bell so you can be notified when I come out with new videos. Okay, and make sure you like and share so we can grow this channel. This is your brother in trading and investing. Absolute, true for law, signing off. Peace.